Chapter 2, Financial Accounting, BADM 211, Analyzing Transactions. This is part 3 of 3, and I'm sure by now, after having watched the first and second video, you're realizing how rigorous accounting can be. You've been learning the rules of debit and credit. You've talked about T accounts. You've talked about how these transactions can be recorded in journal entries. On top of this, from Chapter 1, you learned about transactions and how they affect an accounting equation. And then you learned how to prepare a balance sheet, an income statement, and a statement of retained earnings. There's an immense amount of information in the first 2 chapters in a financial accounting course. So let's build on what we've learned in the first 2 parts. And I hope that you've taken the time to solidify this information so that you truly understand it. You just haven't whizzed through listening to this while doing something else, because this really does take concentration and focus to understand how to use the information that you've gathered so far in this course. So the rules of debit and credit were discussed extensively in the first video, and we need to remember the balance sheet equation, also called the accounting equation. Assets equal liabilities plus stockholders' equity, has a set of rules related to debit and credit. Assets are increased by debit, liabilities, and the 2 types of stockholders' equity accounts are increased by credit. Likewise, the opposite is true. Assets are decreased by a credit. Liabilities and stockholders' equity accounts are decreased by a debit. So this builds further into the retained earnings area, where we've got revenue that makes it go up, and we've got expenses and dividends that are both increased with a debit that make retained earnings go down. If this isn't coming to you naturally, I would strongly suggest that you go back and look at some of the pincasts or some of the other videos found in the Chapter 2 tab on this course. Let's look at what we learned in video 2 of 3 related to journal entries. We talked about the steps in preparing a journal entry, and we talked about as well how important journal entries are in the business world. You can imagine a manager, you can imagine the IRS, the government coming in and saying, wait a minute, where did this transaction come from? And the journal entry records the details of a transaction with the date and the debit and the credit, as well as an explanation. And we're going to find later that we're going to be using these. Okay, so let's start with the talk about how we post journal entries to our accounts. The process of transferring the debits and credits from a journal entry into the accounts is called posting. So obviously a journal entry doesn't give management enough cumulative information. Neither do the T accounts give enough cumulative information. You need both of these pieces of a transaction, of a business accounting records, to be able to make decisions. So let's look at this key concept. When you're posting a journal entry, it's going to go into a T account or a ledger. So let's back up a minute as we go over this key idea here. We want to first focus on the fact that we're doing something called posting. Posting means that I've got these journal entries, and I've got hundreds of them. Every time you go into Walmart or any type of retail store and you purchase something and that item is scanned, it creates a transaction, which creates a journal entry. Now that journal entry, there's hundreds and thousands of these journal entries that can occur every day in a large organization. They need to be accumulated by element, all the cash, all of the accounts receivable, all of the revenue. And that's how we transfer them from the transaction recorded journal entry into either a T account or a ledger. So we've already talked about T accounts, and they're informal. Ledgers are more frequently used to post transactions in a computerized system. So whenever you go into an actual business, they're not going to have T accounts. They're going to have something called the ledger, sometimes known as the general ledger. And the ledger is where the details of the transactions occur. So if you pick up a set of financial statements, which we will do later in this course, and you're looking, for example, at Apple Computer, and you see that they have a certain dollar amount of cash, no doubt in the billions, then that doesn't tell you anything about where the transactions came from. But if you were to be a part of the Apple computer accounting area, you would have access to their ledgers, and their ledgers would show all of the different transactions. These transactions, of course, are known as journal entries. And all of the journal entries are accumulated to show each transaction that makes up the ending balance in cash and accounts receivable, inventory, buildings, revenue. So let's look at this first example that we have, and we're going to move into the month of December, and we're going to illustrate journal entries as well as posting. So on December 1st, Net Solutions paid a premium of $2,400 for a liability, and it covers a 1-year period. Okay, here's the journal entry that you learned how to prepare in the last section that we studied. The debit and the credit. And I have to remind you that this is a posting reference. This is account number 15, and this is account number 11. And here's what we remember to be our explanation. They paid a premium on a 1-year policy. Okay, let me stop here, and let's just focus on this journal entry because it's kind of a new one. Got a little bit of extra information to add to this. Prepaid insurance is an asset. We talked about this when we talked about the chart of accounts in a prior video. As an asset, it is an economic resource to benefit the future. As a reminder, make sure you refer back to some of those definitions that if you've kept track of them, it might be very beneficial. An asset definition is an economic resource to benefit the future. This prepaid insurance covers a 1-year period. It's going to benefit the future. It's not for last year's insurance, it's for next year's insurance. And each of you that has car insurance knows this. So we've got a transaction. And if we want to look at the accounting equation impact, then we look at this transaction recorded below, and we see that cash went down, and we see that prepaid insurance went up. And using the accounting equation and using T accounts helps us to illustrate the impact of this transaction on our accounting records. So notice that this transaction affected only assets. One asset went down, one asset went up. It resulted from this journal entry that occurred on November 1st. As always, if you need to, pause, look at this. Maybe you want to look at the text narrative that's provided in the text. Okay, now we need to say, well, what's the difference in a T account and a ledger? Because these two items have confused students for centuries, and I truly do mean centuries. A T account looks like this, the T, and it records transactions. You see the $25,000 debit, you see the $20,000 credit, $7,500 debit. Now a ledger looks like this, and it's a little fuzzy because I cut and pasted it from another slide, but this ledger shows the exact same thing. Here's that debit, and here's the $20,000 credit, and then here's the $7,500 debit. Now, what's the difference in these two? Well, they both are giving us the same information. I have to remind you, as I said earlier, T accounts are typically used to show us financial statement effects, but ledgers are what businesses use on a computerized accounting information system. So this is what you're going to see in an actual business, is a ledger. And I want you to notice that there's a running balance. This says balance, and this balance keeps up transaction by transaction with the running balance. Now, hopefully, some of you keep an actual physical checkbook instead of just using a debit card. And if you've ever used or seen one, you'll know that it looks very similar to this ledger. You'll record the date of your check, and you'll record, for example, deposits here and checks here. That's your debit and credit. And then the running balance occurs all the way down through, so that at any one point in time, you can see how much money you have in your account. So how are you going to know when to use one? Well, the best thing I can do is say that follow the instructions. Whenever you do the work on your homework, it will be very similar to what you'll see on your exams. But I would also remind you that, one last time, T accounts are used mostly for study and instruction and to see the accounting equation effect. And the ledger gives us a little bit more details. It provides us with this posting reference. It keeps us with a running balance. It shows us a cumulative date, and it's used in the business world. And see for yourself. If I'm a business owner and I walk in and I say, what is this check for? And what date did it occur? This T account doesn't tell me. But if I come down to the ledger and I find this amount on the ledger, I can see the date over here appears to be November 30th, and I can see that I need to go. Okay, so here we have journal entries being posted into a ledger. So here's the journal, the entry that we just did, recording prepaid insurance as an asset, cash as an asset. And this is showing the account. Notice it's account number 15. It's showing that on December 1st, we recorded this $2,400 debit, which recorded prepaid insurance. And we also recorded this $2,400 credit to cash in our cash account. And so that's showing down here. Now, it's kind of hard to give you the full details of how this might work, but it's got quite a few transactions that have been going on, and we're just kind of isolating this one. So notice that we've got a gap right here. It's kind of hard to show a full set of accounting records in a small video, but this is showing that that $2,400 credit to pay for prepaid insurance reduced my running balance of the account cash. Now I'm going to switch colors to maybe help to show this posting reference thing. Okay, this is the posting reference. In the journal, as well as in the ledger, we want to cross-reference. We need to know if I just look at the prepaid insurance account or I just look at... Okay, I'm guessing students just heard the doorbell ring. I answered, and here I am back. We were talking about posting references. I'm guessing that each of you has been interrupted before too. I'm making this recording at my home. So let's go back to the posting reference and pick up where we left off. If an individual comes in and says, okay, what's going on with the journal, and how can I find where this transaction was posted? And posted really just means, where was it moved to? What account did it go to? Then we'll find that this one went to account number 15, which has the word prepaid insurance on it. And sure enough, it's account number 15. This one went to account number 11, which is cash. And if I were to just open up my cash account and say, okay, what page can I find this transaction on? Well, it's on page 2. So where's page 2? It's up here. And it's showing me that this is page 2. So this is the way that these different accounting forms are cross-referenced. So let's pause a minute and let me give you a little history. Probably around 1970, 80, we just started using computers to do this work. I think before, in the 60s and the 50s, there are still some manual accounting records. The journal, back in those days, the journals were done by hand, the ledgers were done by hand, and all of this was posted by hand. And so these posting references helped to see the details. So you knew to go, as I said, to page 2 of the journal to find the details of this transaction. Now that we're, of course, all electronic, you can toggle back and forth between the ledgers and the journals. All right, let's go through step by step and look at these transactions for the month of December. They're in your text. I'm going to go relatively quickly. I want you to remember as we're doing this that first of all, this is the journal. Secondly, this is showing the accounting equation impact through T accounts. Notice now these T accounts have added posting references, and the posting references are here. And you can look in your text, because the ledgers are usually very lengthy, you can look in your text and see what it would look like in a ledger. All right, so on December 1st, rent was paid for $800. Payment of the rent is on the 1st of the month. We record rent expense and credit cash. Debit rent expense, credit cash. What should you be doing as a student? You should be thinking cash went down because it was a credit. Cash decreases are recorded as a credit because it's an asset. Assets are decreased by a credit. Rent expense is a part of stockholders' equity. It makes my stockholders' equity go down. Stockholders' equity is increased by a credit, but it is decreased by a debit. And so since my rent expense went up, it's recorded by a debit. But the ultimate expense is that stockholders' equity is going to. Unearned revenue. Let's pause as we talk about this tricky transaction. Net Solutions received an offer to rent the land purchased on November 5th. The retailer was going to use it. They bought some land and they were going to rent it out to someone else. And they agreed to rent it for 3 months, and the rent's going to be payable in advance. They charged $360 in advance. So the essential component is that Net Solutions got a check of $360. It's always the easy one. Here we record the cash, $360, debit to increase. Our cash has gone up. Unearned rent is a liability, and it also has increased. Now, some of you may remember that we talked about this in a prior video, but unearned rent is a liability. The business either has to give the local retailer their $360 back, or they have to actually have the rent expire, have the business use the land, and then they have earned the rent. Next transaction, purchase of office equipment, which is an asset. The company buys the equipment on account. That's that tricky language. On account means that they charged it. The executive supply company said, sure, you can charge your purchase of equipment. So they record the equipment and they record the liability. Equipment is an asset and it is increased by a debit. Accounts payable is a liability and it is increased by a credit. As a reminder, our debits and our credits equal. Oops, sorry about that. A credit for my cash. Get my pointer back out. A credit for my cash here because cash went down. A debit for miscellaneous expense because miscellaneous expense went up. December 11th, Net Solutions paid creditors $400. So they owed some money to their creditors, and now I'm going to tell you from a practical standpoint, they should have indicated which creditors, but that's something you'll learn as you get into the accounting world. They wrote a check for $400 and their liabilities went down. Accounts payable is a liability. Liabilities are increased by a credit. As a result, they are decreased by a debit. Paid the receptionist and a part-time assistant their wages. Credit cash, debit wage expense. Notice that debits generally come first in a transaction, and you will be able to see that more clearly when you do your homework, where it's a guided homework and it gives you the template and you can see that that the debits will always come first. Net Solutions received revenue in the way of cash, always a good thing. Cash is increased by a debit. Fees earned, which is the same thing as revenue, is increased by a credit. Another customer, $1,750, but this customer, instead of cash, said, I would like for this to go onto my account. What that means is that this customer will pay later. $1,750 increase accounts receivable. It's an asset. And $1,750 credit for fees earned. It is a part of stockholders' equity because it makes retained earnings go up. As a result, it is a credit balance. Net Solutions decides to pay half of the money it owes for the purchase that it made previously. So it writes a check for $900 here, and the liabilities go down, cash goes down, and liabilities go down. And because cash is an asset with a normal debit balance, you credit to make it go down. Liabilities are normally increased by a credit, so you debit to decrease them. Net Solutions received some of the money. Now, this is one I need to stop and get everybody to pay attention to this piece. First of all, it only is a transaction that affects assets. So a customer that owed us money, $650, is going to pay us the cash. So we record the cash, and we record a reduction in our account number 12, accounts receivable. And there's no new revenue earned. Many students think that you've earned more revenue, but you haven't. This customer is just paying you what he owes you. You recorded the revenue when you earned it, even though the customer didn't pay you. So this customer paid you what he owed you. It's just like when you pay your credit card bill, you don't get anything else for doing that. You're just paying a bill that you owe. So this customer doesn't get anything new. They're just paying a bill that they owe. Cash goes up, receivables go down. Again, our accounting equation continues to be balanced. Supplies purchased, supplies as an asset, paid cash, supplies go up, cash goes down. Wages paid, wages are an expense. They make my stockholders' equity go down because they make my retained earnings go down, because retained earnings are decreased by expenses and dividends. And cash goes down every time we write a check. That's pretty much common sense. A lot of common sense to this. An electric bill comes in and we pay it. The expenses go up. Cash goes down. And an electric bill, $225. And we get some of the fees that from a customer, and this is in cash. You always have to pay close attention to whether it is cash received from a prior accounts receivable or from actual revenue. And in this case, it's actually revenue earned. So we get to record this revenue, cash going up, revenue going up. And in this example, we earned some more revenue with accounts receivable going up and revenue or fees earned going up. Finally, dividends of $2,000 are paid to the shareholders. And in this transaction, dividends are increased by a debit. That's that DEA are the accounts we debit. Dividends are increased by a debit. This is account number 33. And they make my stockholders' equity go down. They don't affect my income statement, but try to think of what financial statement they go on. That's part of your homework. And that financial statement is the statement of retained earnings. And similarly, cash is going to go down. So you can see we've had a lot of transactions in cash. So wow, here we go. This is huge. And this is where you see all of the transactions together. This is all of the transactions that occurred in the cash account. And there are numerous transactions. If you look in your textbook, it's probably better. There is a full running balance of all of the transactions that occurred. It's always a debit balance because cash, if you have a credit balance in there, that means that you've been bouncing checks. This is our ending balance of accounts receivable. And this ending balance of accounts receivable shows the various transactions that we have. Here's the account title supplies and what we have left. Here's prepaid expenses. Here's our land, our office equipment. So those are all of our assets. Now let's look at our liabilities. Here's accounts payable. It shows all the various transactions that we've had, the debits and credits that make our accounts payable go up and down. Here's our unearned rent. That was one of our liabilities because someone rented our land from us, paid us in advance, and we don't record that until we earn it. We haven't earned it yet. We'll earn it as time passes. This shows the common stock the company has from the November 1st transaction. This shows the dividends. Let's continue to go. Revenue. Doesn't matter if the revenue is received in cash or if the customer charged it. Notice it's a credit balance all the way down. And here's our various expenses: wages, supplies, rent, utilities, and miscellaneous. And so each journal entry recorded in a journal providing details of the transaction is going to be posted or transferred into the general ledger. And the general ledgers look like this. Again, as a reminder, these should look like your checkbook because your checkbook is going to have whether the transaction was a debit or a credit here. And then there's going to be a balance, and we're going to keep a running balance of the total. And from this, we're going to find that we can actually... So once you've finished all of the ledgers, the debits and the credits should be equal because every transaction you made, every journal entry that you recorded and posted, the debits equaled the credits every single time because we have an algebraic equation, and that algebraic equation is the balance sheet equation or the accounting equation, and the elements are assets equal liabilities plus stockholders' equity. So just like in your elementary algebra that you probably studied in middle school, this algebraic equation will equal. So the equality of the debits and credits should be equal. This is what the trial balance is going to look like. So it's literally called a trial balance. It's considered an unadjusted trial balance because we're going to find in Chapter 3 we have to make some adjustments. But notice we have a title up here. This is as of December 31st. These are all the account numbers. And I have to pause and let you know that when you're doing this by computer, you literally put in the account number 11 and the account will pop up for you. All the debit balances are listed here from the general ledgers, and all the credit balances are listed here from the general ledger. And as you can see, they equal. So fortunately, our trial balance equals. And from this, we'll find that since it's unadjusted, that obviously tells you something else needs to be done, that we're going to learn how to make some adjustments to make sure that these numbers are accurate. So what we've got here at the end of Chapter 2 is this. We've learned about transactions and how transactions are a part of the business world. And each transaction has two parts that fit into an accounting equation. And that accounting equation is actually one of the three financial statements we're studying, the balance sheet. The balance sheet can be expanded into the statement of retained earnings and the income statement, which are all tucked in under retained earnings, which are part of our stockholders' equity. what we find is that if we record all of these transactions in a journal, from that journal, post them to our ledgers or our T accounts if we're not using a computerized system, then after we finish a full cycle, an accounting period, and this is through the accounting period December 31st, then we can check to see, are our debits and our credits equal? And if they are, then we know that it's time for us to complete. And that's what we'll be doing in Chapter 3, which is preparing adjusting entries to make sure that all of these accounts actually have the correct balance. For example, we might find that we've earned some of that rent. We might find that we forgot to record an accounts receivable. We have to do something to that office equipment that's sitting there. Some of our prepaid insurance has probably been used up. So what we've done in chapters 1 and 2 is introduce and expose you to the elements of bookkeeping. When we get to chapter 3 next week, what we'll find is that the true logical educated component of accounting comes next. And when I say educated, it has to do with being educated about the rules of generally accepted accounting principles. And that's part of the adjustment process. And essentially, the rest of this course is going to be adjusting. So my hope is that this is helpful, that you look at the pencasts and the videos, the narrated PowerPoints, you do the homework, you do the quizzes, you use your text resources, and that you get a strong foundation in Chapter 1 so that we can springboard off to Chapter 2, where we go to bigger and better things. Please let me know if there's any way that I can assist.